Barney, as I say, thank you very much for joining. My name is Richard Bradstock. I'm the founder and managing director of the RPA group. I'm actually sitting here in Dubai at the moment. I know we've got people from all over the world joining. So good morning and good evening. I'm sure, I think we've got some people over in Hong Kong as well. And I've been, just to give a little bit of background on myself, I've been over here working in, well, I've been in Dubai for 18 years, but working in UK property for my entire career. So best part of 22 years now. And so what I'm going to do today is do a quick recap of the year to date and what we expect, or what I expect to happen in 2024. I think clearly it's been quite, in many ways, in many different aspects, quite a tumultuous year. And so it's quite important, I think, to take time to look back and also assess where we're likely to go, particularly with regards, obviously, for the purposes of this webinar, for UK property in 2024. There is a Q&A box on your, it should be on your screen. If you hover with your mouse somewhere on there, you should be able to see a Q&A box. Please do feel free to type questions in as we go, and I'll do my best to answer them. So I think, for context, where better to start than where we were 12 months ago. So this time last year, you would have been forgiven for thinking that UK property was finished, that there was no point ever buying a UK real estate asset ever again. You know, the headlines were awful, the interest rate was going up, even people as senior as Deputy Governor Bank of England were saying that house prices were going to drop by 20%. And quite honestly, as someone that owns and runs a property business, it was a concerning time for me as well. I think what is really pleasing over the next 20 minutes or so is that where we sit today is so far from these kind of doom and gloom headlines. The graphic on the right it's from the Sun newspaper, so hardly a really reliable source. However, it was symptomatic. I put it in there because it's symptomatic of the headlines that were out there. Our message 12 months ago, and as soon as really Liz Truss as Prime Minister put her disastrous budget together back in October of 2022, was very simple. It was, don't panic, buy well if you're buying, and don't sell if you don't have to. It was that simple. I've, as someone that's been through in my professional career working in UK property, we've been through the GFC and the global financial crisis in 2008-9. We've been through Brexit. We've been through COVID. We've been through, we're going through this sort of inflationary crisis that we have or been having at the moment. And each and every time, the UK market has proved extraordinarily resilient. And the worst thing anyone could ever do is panic and sell. And so we're in this sort of, I was very passionate 12 months ago, and I'm very passionate today about the market. But the messaging has changed. 12 months ago, it was don't panic. Today, as hopefully I'll be able to demonstrate now, is that there are opportunities in the market. There are things and investments to make, and the timing is now, I think, right to be buying. And so hopefully over the next few slides, the next few minutes, you will see why that is. Just a quick sort of review of the root cause of the concern around the property market. So inflation had, from midway through 2021, been steadily climbing and then shot up at the beginning of 2022. obviously one of the major things that one of the major tools that central banks have at their disposal to combat this is interest rates, base rates. And so what we then saw was 14 consecutive rate rises from a base rate of, at the time, 0.25% all the way up to 5.25%, which is where we sit today. What's been encouraging over the last three months or so is that they haven't seen fit to actually raise that rate any further. And actually the chat now has really completely changed from predictions of base rates hitting 6.5, even 7%. You know, with the news that inflation in November hit 4.6%, or decreased to 4.6%. Suddenly, we're in this position where actually, as early as May, June next year, sort of experts in the market are predicting that the Bank of England will start reducing rates. So this is a very positive sign for the property market moving forward. And whilst, as it says there, whilst these interest rates will continue for the time being to have a negative effect on domestic transaction rates, what that actually does is provide opportunity, if you're clever, if you're sensible, for an overseas buyer that perhaps sitting in US dollars or dollar-based currencies with a weak pound, and can access some really good product. As we saw from that first slide, serious people, serious bodies of statistical bodies predicting huge depreciation in UK property in 2023. This has simply not happened. Prices are down on average 1.2% year on year from 2022 to date, I should say. October, November have actually seen slight price rises. But what I would say is, again, this is very location specific. You have to be very careful, as always, very, what's the word? Do your due diligence, do all that background work to make sure that where you're buying and what you're buying is sensible. And what's striking here, as I will show you in a second, is that whilst the average the average prices have decreased, there are plenty of examples and plenty of sort of more localized areas where we've actually seen price rises. So this is not a market that's in any way disastrous or in any way an enormous problem. This is a market that is extremely resilient, has massive undersupply problems, as I'll show you in a second. And as soon as we see mortgage rates, base rates even start to drop slightly, we will see the domestic market return and we will see prices start to rise. And this is, as someone, as I said just now, as someone that's been involved in 3 or 4, worked in the industry for long enough that we've seen 3 or 4 crises in that period. The one thing that we do see time and time again is that a year later, 2 years later, prices are up. And so whilst this isn't a carte blanche thing, you can't just go out and buy anything. And you do have to be careful, especially now, about what you buy. There is opportunity, and we are in a situation where, ultimately, just a very, very different situation to where we were 12 months ago. We're relatively positive compared to this sort of doom and gloom and the headlines and the end of the UK property world as we know it that we were seeing 12 months ago. So, it's very encouraging. Just very quickly, now anyone that was on my the webinar, half-year webinar I did in July, I think it was, will have seen this slide before. So a little bit lazy of me perhaps to leave it in, but it does demonstrate why we aren't seeing a crash. We're in a position where there are less planning applications going through the system than handovers of new property. So that in itself is a fundamental concern for anybody in government who's trying to provide, housing solutions for people. There is a housing problem where there is simply not enough property being built. And this is reflected in how resilient prices are, but also in the rents, as I'll show you in a second. Demand is an interesting one, because obviously one of the key things that in the sales market that lead to a decrease in price is obviously a drop in demand. Now, what you will see here is that actually the table on the right, the graph on the right, is taken from the government website, published I think a few days ago, from gov.uk. And this just shows that actually, whilst there has been a decline generally in demand, it's actually held up pretty well despite interest rates. But what we've seen in the last 2 or 3 months is actually that demand and therefore and transactions actually increasing. So we are going to see, I think, when the land registry figures, whenever they're published, are always 2 to 3 months behind sort of real-time data, as it were. And so I think what we're going to see is those transaction levels reflected up in November and December. We're going to see slight price rises, which has already been reported, albeit not by official government channels. And we're in a position where actually the demand is returning to the market. One of the things that has, in terms of, if you're an investor looking at the UK market, one of the reasons we were saying don't panic is because ultimately rents have been extraordinarily strong. You can see from the graph at the bottom here that over the last 2 years, actually cumulatively, rents are up well over 20% in that period, over that sort of 2.5-year period across the UK. You can also see this reflected here in this top graph. Now, this top graph is also showing where Zoopla, this is a report from a few days ago, where Zoopla believe that the rental demand will go over the next year or so. Now, this to me makes perfect sense, in the sense that there is this fundamental lack of property on the market, lack of building, lack of supply coming to the market, which has meant that we have seen dramatic rent rises in that period. Now, that you can see here, you can see these numbers here. You just cannot sustain rental increases of 10-15% per annum. It's not sustainable. And we are seeing in some locations renters start to push back a little bit by choosing not to take, by choosing to move to other locations rather than pay the really high rents that landlords are trying to charge. That said, that is not a problem or anything to be concerned about, because whilst we're talking about reducing rises in rents, we are still talking about rises in rents. We're just not talking about 10 and 15% per annum rises. If you look at, London is a fantastic example. That black line there is London. So we're now in a situation in London, for example, where a year or two ago, rental yields of 4% or above 4% were really rare, really quite rare. Today, you can go and get a 6% yield. And what that means is that whilst the rents have gone up, the prices haven't really gone up. And again, that presents an opportunity. So I think this is a very positive story, and it is something that has offset the mortgage market in a significant way. So whereas the cost of borrowing has gone up, obviously quite a lot over the last 12-18 months, rents have gone up 20-25% in that same period as well. And so whilst as an investor, your costs have increased, actually rents have increased dramatically, and have sort of actually sort of exceeded those rent rises from a mortgage perspective. So we are seeing, people talk about property as a traditional hedge against inflation. And this is primarily why, because as inflation goes up, so do your rents, and that will offset the cost of borrowing. Now, as I said just now, there are base rate predicted drops as early as May in 2024. And that was actually an article in The Guardian, which is obviously pretty left-wing and anti-property, and so I thought it was quite interesting that they were calling it as early as that. And then sort of coupled with that, we're also seeing banks being extremely competitive, starting to become extremely competitive on rates. So just a little example of that. So just a personal example, I have a property in Deptford in London, and I was on a variable tracker rate, and my mortgage went all the way up to, I think at the highest point, because it was 2.79% above base, it was almost 8.5% I was paying on a monthly basis. And for the first 6-9 months of this year, they didn't entertain switching me onto better rates. In the last couple of months, they've suddenly started offering cheaper and better rates, because what they've realized is that me as an investor, me as an owner of a property in the UK, suddenly with other banks cutting their margins, offering better rates, suddenly they're needing to compete. And so I got an email from them saying, click here, choose your new rate, and away you go. And so suddenly I went from 8% to 5.5%, I think it was 5.69%. So this is a good example of what's starting to happen in the market. Banks, regardless of the base rate, are becoming more and more competitive. Banks have had it too easy for 15-20 years now, with the base rates being as low as they were. They were making significant margins and not having to really compete, because money was so cheap, people were just happy. Now, today, they are having to compete, and this is a good thing, and this will continue to sort of develop. This article on the right is literally from the Telegraph this morning. It was on their live feed on their main page. So again, there's lots of this sort of news out there, and all of this is very positive from a market perspective. The better the rates, obviously, the more buyers there will be in the market, and the key there is the domestic rates. So we are now starting to see HSBC. Just again, if I was a domestic buyer, domestic based mortgagee, I would have been able to get a rate of about 4.6%. So suddenly these aren't actually bad rates at all. So we do expect, therefore, as mortgage rates drop, as rental costs continue to rise, albeit perhaps not at the same rate as they were rising before. Nobody wants to rent, so people will start buying again as these rates become more and more competitive. And I think what we'll then see is, particularly in the last 6 months of next year, we'll start to see prices move fairly significantly upwards again. So what this means, again, is that there is an opportunity now. I think the other thing just to mention here is that, I think on the, in fact, if I just scoot back to it for 1 second, here we go. So Manchester is 0.2% down year on year. So that's an average across the market. What we're trying to do as a business here at RPA is help people get access to the right product, the right opportunity, the right sort of price points that will mean that you outperform whatever's happening in the market now. So the key aspects here are threefold or fourfold, really, actually. I'll come to location in a second. Off plan today, if you're an investor, is actually a really, really strong strategy. As long as you're buying with a good developer, with a track record, with all the sort of requisite financing, etc., in place, this is a really sensible thing to do, because what you can put down a lower deposit now, you can perhaps strike a little bit of a deal, and you can wait until handover. And this will then allow you to secure a better mortgage rate, because we do, as I've just said, we do expect mortgage rates to drop over the next 12 to 18 months. So if you can buy well now, you don't have to put that much money down. You secure your place in the market at the right time, and then you'll be able to get a better mortgage rate when that comes around. So linked to that is the, obviously with the payment plans, the lower deposit structures and the handover date. I just wanted to highlight one of the sites that we've been working on this year, Victoria Riverside. Now this is pretty much sold, so please, whilst we are a sales business, I'm not trying to sell this particular one to anybody today, but this is a great example of a site that works. You can see there 1 bed's from 274,000, 2 beds from 339,000. This has probably been one of the fastest selling products in Manchester this year. And the reason for that is because it's a fantastic developer in an extraordinary sort of regeneration area where you can see clear value increases over the next 10, over the next 5-10 years because of everything that's going on. And they're asking for 10% down now and 10% 12 months later. So on a 1 bed, that was as little as £27,000. On a 2 bed, £34,000. These aren't enormous sums of money to secure a price point in that market. Now, I can tell you now that everything pretty much, bar literally 4 or 5 units, is now sold in this development. It's sold extremely well, even in this market. And over the course of the last 12 months, they've probably put the prices up 7 or 8%. In 2% increments 3 or 4 times. So, and it's sold and it's continued selling. And so this is a testament, first of all, to how good a site it is, how well priced it is, and the payment plan. And so if you can find something along these lines, there are still properties and parts of the markets that are performing extremely well in this market, regardless of interest rates, regardless of everything else going on, because there is this just extraordinary demand for property. And then location. That old saying, location, 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 is so true with property. You have to make sure that where you're buying is sensible and what you're buying is sensible. And that is what we at RPA are here to try and help you do. If I think about what I'm doing with my money, for example, I think London has an exceptional story over the next 5-7 years. There's a stat there that the UK has seen 32% house price rise in the last 7 years. London's only up 12%, and with rental yields of 6% now available on new builds, this is looking really, really attractive. So if you have the budget, London is right up there in terms of what I would be doing. It's still the top 2-3 major cities in the world. It's still the most sought international location in the world. And coupled with that sort of the relative affordability, relative value, you've got really strong rental yields. And then Birmingham and Manchester. So you can see here on the right-hand side, this is a table taken from Savills. So Midlands and North. So this is quite generalized, but these numbers, if you drill into it, I didn't have space on the slide, but if you drill into it for the individual locations, they're actually slightly higher for Manchester, for example. But 21% growth predicted over the next 5 years. London, prime central London, 18%. This is really, really, exceptional. These are really exceptional numbers. And so if you can buy sensibly, and you don't necessarily have to mortgage yourself up to the hilt, so perhaps borrow 60% rather than 70%, and you can manage those sort of those outgoings from a cost perspective. This is a really, really opportune moment to do something. So look, obviously I'm in sales, and we are a sales business, and we would love you guys to come and buy a property from us, of course. But I've been in this game long enough, and in the markets as an investor and as a professional working long enough, and I've seen, as I said just now, 3 or 4 major crises that, each and every time there were headlines saying it's the end of property, don't buy property, it's the worst thing you can do, all these sorts of things. And every single time prices have increased. Now, my view here, I would imagine that given that you guys have chosen to take half an hour out of your day to listen to me talk, that you're, to some degree, you're probably of the same mindset, in that you believe property is a good asset to invest into. But why I say that this is the most significant buying opportunity since 2009 is effectively fourfold. So 2 years ago, when the base rate was low, mortgage rates were really cheap, you had Help to Buy running in the UK, which was, for those of you that don't know, was a government assistance scheme that helped first-time buyers purchase property with effectively additional loans from the government. When you had all of this, the overseas market wasn't really necessary for UK developers. If you're Barratt or any of the major UK house builders, you didn't need someone sitting in Dubai or Singapore or South Africa or wherever you might be. And consequently, the product that was often brought overseas was not actually what was selling locally. Today, that has changed. Today, the overseas market, because of the reasons we've discussed, is very important for the major developers, because they've still got to hit their sales targets. They've still got to finance the builds and all these sorts of things. And so suddenly today, the overseas market's very important. And what that's meant is that for me as an agent sitting in the Middle East right now, or wherever we are, and my team all around the world, we now have access to products that we just simply didn't before. And as buyers overseas, that obviously therefore reflects to you guys as well. So you can go and buy outstanding assets with excellent payment plans for prices that have either not gone up or decreased slightly. As I showed you with Victoria Riverside, the best developments are going to buck this trend, and the key therefore is to be in early and make sure you're buying at a price that makes total sense as an investment. We've got a weak pound against most currencies, but particularly anyone that's dirham dollar based. And I know we've got people on here from Nigeria and South Africa and so on, where you've got your own currency concerned with the rand or the naira, and again, putting money into the pound right now makes sense for slightly different reasons. And then we've got rents at all-time highs. So it is a great time to be a landlord. So if you are in the lucky position to have some cash that you could deploy, I genuinely think this is the most, as it says there, at the risk of repeating myself for the 15th time, the most significant buying opportunity since 2009. If you wait, I am convinced, as someone that's been in the market for 20 years, if you wait, there's probably 6 months, 9 months, maybe, to go out and do something. Otherwise, you will end up paying more for that unit that you're trying to buy, or it won't be available, because either the development will have been sold, or they'll be selling it domestically, and so therefore it's not available overseas. So I think this is just something to consider. Clearly, the most important thing for any investor is to make sure the time is right for you. Forget the market, forget what the market's doing for a second. You have to be able to afford it, and you have to it has to be the right thing for you, for the right reasons, and at the right price, so that nothing is you're not overextending yourselves, etc., etc. But if you are in a position where you're able to buy, then I do think there's a significant argument to doing that now or in the next few months at the very least. So I did just want to just very quickly just highlight a couple of things. So now, if you sat here and listened to me and thought, well, I've already got property in the UK, I agree with you, but it's, you know, it's not for me. I did want to highlight the fact that we have just launched something in Germany, which a lot of what I've talked about is, you know, a lot of the same reasons and same arguments apply. Germany's also had its own inflationary problems. It's actually handled them a bit better than the UK, and growth is probably a little bit higher from a capital value perspective over the next 5 years. I'm not going to talk more about that now, but just to sort of show we do have options. If you have euros, for example, that might be something you want to think about. We've just launched a site in London in Canary Wharf. Aspen will have further London opportunities in the new year. And again, this is something that is a great example of something with a fantastic payment plan where you can put, you know, 5% down and get in and fix a price. Now, this is something that you know, again, price-wise may not be for everybody. Probably, you know, it's probably for relatively few people. But again, it's something that has sold exceptionally well this year. And anyone buying that will be very pleased they did in 12 months' time. It's another example of a site that has actually increased in value slightly over the last 6 months. And then coming in the new year, we have 2 brand new launches, one in Manchester, one in Birmingham. Reasonably comparatively priced. You know, we're talking 250k in Birmingham for a 1-bed, 280k in Manchester for a 1-bed. Both of them are off plan, both of them complete in 2025. Both Manchester 15% down and Birmingham 20% down. So again, you can get access to these for, you know, as little as sort of 35, 40k, depending slightly on units and which one, etc., etc. But these, the One Victoria site, for example, this is right next door to Manchester Piccadilly. You know, you're right in the heart of Manchester. It's very competitively priced, great developer, well under construction, and I think, you know, again, you could do far worse than have a look at something like this. Just to round off, I think I've been going for 30 minutes now. I promised 25 minutes, so I apologize. But the idea behind RPA and the business and what I've been doing in the Middle East here for the last 18 years, 17 years, whatever it is, and what my team can offer all around the world is genuine advice as to what works, how to do it, and whilst providing, you know, full due diligence, full access to everything you need to know about the properties we're offering. You know, we are an agent and we have access in theory to the whole market, but what we try and do is do the due diligence on a handful of really good products that offer a range of sort of completion times, build periods, price, location, but the most important thing in this process is you as the investor. What we're trying to do is understand what you're trying to achieve and provide, you know, ultimately the right advice, a proper sort of strategic service, if you like, linked to everything else you're trying to achieve in the investment world. You know, property is definitely something that everybody should have as part of their portfolios, but it is also part of a portfolio. And so I would like to think that we're quite considered about that and can help you make those decisions and understand what you're doing and why you're doing it, and then perhaps provide some solutions for that. We also have access through our partners in the mortgage world. We have a sister company, Brick Management and Lettings, who can provide all the lettings and management services. So if you already own property in the UK and perhaps you're not very happy with how that's being run, we'd love to have a chat to you and see if we can help you on that. But yeah, as I say, the idea is a full, overused phrase, but one-stop shop service. And And whilst clearly I've been sitting here selling the buying opportunity now, and I 100% stand by that. I think that is something that, you know, if you can do it, you should be thinking about it, even, you know, even if it's not with us. But you know, if you do come and sit with us, we will provide a very sort of, as I say, a tactical advisory service, as opposed to a hard sale. You must buy this. I do think if you've got the money, you should be doing something. But the key is making sure that you're doing the right thing. And that's who we are. I don't think we've had any questions come through on the on the panel, so hopefully I've answered as many as I can. Anyway, if there are any questions, actually, I think Shaib put his hand up, but I'm going to need you, if you do have a question, to type into the Q&A box. Actually, we do have a question. Sorry, we do have a question. I've just I was clicking on the wrong thing. We've got a question around mortgages in terms of how much is now possible to borrow given the change in the sort of mortgage market. Actually, the amounts you can borrow are still the same. You know, you're still in theory able to borrow up to 75%. What we would strongly recommend is that you don't ever make a decision based upon a 75% mortgage, because there's too many variables in that. What we would be advising is perhaps a 40% down deposit, 60% loan to value. That's what you work your numbers out as. And if then you come to completion and you secure finance at 70%, well then, yeah, and you choose to do it, then that's great. You can you don't have to put as much money in, but yeah, you are probably looking at as I say, 60% in terms of how much you can borrow. And in terms of the rates, it's very dependent on your location. You know, rates in for someone based in Nigeria, again, unfortunately for them, be higher than someone based in the UAE or Saudi, for example. Abdul, thank you. Got a question from you regarding the sort of process buying in this specific case in Birmingham. I mean, generally speaking, it doesn't matter on location. There is a process where you have to provide your passport copies, you have to provide proof of funds. So the UK AML, anti-money laundering, is incredibly strict now. So what that means is that you will have to submit 3 or 6 months bank statements. The lawyers will, and sometimes the developers will have to go through those, and they'll ask what might seem like quite intrusive questions about where this money's come from. They particularly don't like cash deposits, albeit there are ways around this, and as long as you can justify them, there's no problem. So ultimately, it's proof of who you are, proof of where the funds have come from, and a proof of address. They're the 3 sort of key things that you need to provide when buying a property in the UK. Shaib, you've got a question around taxes. So taxes, what I would say is I'd be more than happy to take these offline and sort of specifically answer these on a one-on-one session with anybody that would like to do so. But very high level from a tax perspective, when you buy property in the UK, there is a stamp duty tax, which is an acquisition tax upon purchase. If you're a non-UK resident, there is automatically a 2% stamp duty. There is a 3% stamp duty. This is of the value of the property. If you are buying property and you already own property, and that could be anywhere in the world. And then above £425,000, there is another banded stamp duty. So at a base case, everybody probably on this call who's not based in the UK will be looking at 5%. If you own other property, minimum of 2%. And then above that, you have, because presumably if you're doing this from an investment perspective, you are renting the property out, Therefore, you're generating income in the UK, and so in theory, there is potentially income tax as well in the UK. However, if there are ways to mitigate this, you can buy it in a company structure, for example, which does help mitigate. But ultimately, if it's just one or two properties, it still remains quite tax efficient, and you shouldn't be in a position where you'd be paying any or many or much tax. Again, probably quite a high level answer, but it can be done very tax efficiently. And then another question around transferring property to your children. Again, this is it's all possible. If, depending on their age, one of the most sensible ways to do it is actually to have them on the title right from the start, which is, but they have to be 18 at that point. And if they're not 18 and they're younger than that, and you want to transfer it to them in the future, well then, again, I mean, it can get quite convoluted, and we just need to sort of look at the specific ways of doing that. But typically, you know, if you were to pass away and the property was then inherited by your children, you know, again, depending on value, there may be tax involved there, but as long as you're set up correctly, there probably wouldn't be. I think that's everything. So look, thank you very much for your time. I hope you found that useful. It's ended up being 40 minutes, not 25. So thank you for your patience. I'd be more than happy to have a chat with anybody that would like further information. We have representation in South Africa, in the Middle East, in Hong Kong, in the UK. So we can provide you know, on the ground services as well. And ultimately, yeah, I do think there is a really strong argument to doing something now, but it has to be right for you. And part of the service we offer is to really break it down and make sure that you understand everything there is possibly to know about that potential purchase and all the costs involved and all the ramifications. And as you probably gathered from the way I answered the questions just now, I'm not a tax expert, but we can provide access and introductions to people who are. So with all of that in mind, do look forward to hearing from you, hopefully in the future. Thank you very much for joining today. Hopefully you found that useful, and we will speak hopefully at some point soon. Thank you very much, and we'll be in touch. Thank you. Cheers.